Hello, everybody, all you everyday traders. This is Eric Hale with Trader Oasis. We're here to quickly update some stuff that happened this week and recently and share some information with you folks. I'm joined by Greg. Say hello, Greg.
Howdy, folks. Welcome, welcome. Before we get into everything, like, subscribe. And if you have questions, please put them down in the comments section. We'd love to answer them there. If you have ideas or things you want to talk about or hear us talk about, please let us know.
Yeah, so both of us actually, Brent Donnelly tweeted out this morning that nerd used to be a derogatory term, and now it's a compliment to call somebody. Both you and I consider economic nerds, and so we dive a little deeper on some topics. So if there's anything specifically you're interested in learning more about, ask down below, or if there's something we talk about and you're not sure that you understood what it is, do us a favor, give us some feedback and say, hey, you'd like to learn more about this, and we'd be happy to address it in the future. So we wanted to start off first just talking about probably the thing that's on the top of the headlines is some big earnings.
Wait, hold on.
No,
before you talk stock market, World Series starts tonight.
I can't go for the cheaters.
I can't either. I'm pulling for the Phillies. I hope Bruce Harper hit. Oh, I know. I always love.
Who do I think is going to win? I think Houston's going to win.
Probably.
They're favored. I don't know. I used to be a Houston fan. I liked them when they were in the National League. I really loved it when Houston played the Cubs when they were in the Central Division. It seems weird for them to be American League, but
the crazy thing is there's actually not that many of a lot of the team that was on that team that cheated has left. Yeah. The problem is you still have Altuve and Gurriel and Bregman and Verlander, right? But other than that, a lot of the team has changed. I mean, this young new Astros team is really good.
Yeah.
So I probably agree with you. I think the Astros I'm going to say they take it in 6. But I'd love to see Bryce Harper just light it up and become the World Series MVP and win it for the Phillies. That's what I'm pulling for.
Well, you're a big Bryce fan always, haven't you been?
I have been.
Don't you have a Harper jersey?
When he was a free agent, yes, I have a jersey, back from when he was with the Nationals. And when the Nationals were trading him, I know the Dodgers were in the mix, and I was hoping that Harper was going to land in Los Angeles, but that's all right. I still like the kid.
Okay, so there's baseball. It seems weird.
All right, sorry. Back to
and then Halloween. What do you got? Hey, what's going on Halloween? Are you got your costume picked out?
No.
I think I'm going to go as Janet Yellen. No, kidding. Have you seen the memes?
I would pay money for you to just Janet Yellen.
Have you seen the memes going around from Spirit, whatever's the costumes?
Spirit Halloween? No, I haven't.
Spirit Halloween.
I'm making a note to go look for memes.
Yeah, we didn't talk about this. There's a bunch of them going around that are pretty hilarious. Yeah, some of them are. I just Googled some, and the first one that came up is not correct. But there's one of Nancy Pelosi. It's like stock traders or successful stock traders, and it's Nancy Pelosi.
Nice
costume. Yeah, so they're worth checking out for a little bit of a laugh.
I'm probably gonna go on the old standby. I've got a pirate hat and a big black cape that I usually wear around. So, I'm gonna be the Dread Pirate Roberts.
Oh, there you go. That's a good one. For those of you, that's a reference, of course, to Princess Bride, which is probably the best movie ever made, but depending on your opinion.
Top 5 for sure. Top 5.
Top 5. Okay. Let's talk about probably the biggest news. One of the equities that you and I are both big fans of, we trade quite frequently, is Apple. So Apple's up huge, had fantastic report, beat on earnings, beat on revenue, really good report. I thought was amazing is last night watching intraday, I was watching the stock after hours. So here's the close yesterday, and we were down a little bit, and then, here's the close. So this right where my cursor is, and we shot down on the open. I mean, we went down into the 130s. There was some prints down there, which is scary because somebody ended up selling down, down at 137, 135 or whatever. And at the end of the day, I mean, this, overnight in the morning, we were up a little bit. I mean, not much higher than where we were. In fact, but look what has happened as we opened and just rocketed right up. This is an intraday chart going back to the daily chart here. This is, big, strong move by Apple. Looking like we've got, technical signals that were confirmed. We had bullish signals a few days ago. I'm always cautious to trade bullish over earnings. I traded a collar trade that does really well in either direction. It's actually a very explosive trade. So if the stock goes down, you make money. Stock goes up, you make money. So looks like my options are making money, or my stock's making money. My options I'm going to be closing those, but net, I'm ahead on that trade.
Yeah, I was really impressed by their report as well. I thought it was interesting. Like you said yesterday, the initial reaction was down, and even some of the headlines that came out were, Apple beats on, revenue and earnings, but iPhone sales were light and missed estimates. And so it's almost like the media was looking for some type of story to tie Apple into a failure for the quarter, because of, a lot of other big tech has failed, right? I mean, we've had some really bad reports from Microsoft and from Google. The worst one, of course, being the one from Meta. That is a horrible story right now. Meta's down 75% from their high. That's really bad. That's a lot of wealth erased in the last 9 months, 10 months.
Yeah. It's a really scary thing. And, this was actually a direct impact of Apple. What happened to Meta is Apple. Apple made dramatic changes this year in their privacy and the ability for people to be tracked for ads. And it's taken it right out of the shorts of Apple. The other one that got
Facebook, Meta, you mean?
I'm sorry, Meta. Apple ended up impacting Meta. The other one that got pummeled, of course, Amazon was down, which is a big surprise to me. They're talking about stepping back, not only in retail sales, but they've also are talking about AWS, their web services, that they're seeing others either. I mean, there's a lot of discussion. The theme seemed to be on recession and dialing back. I mean, I don't know. What are your thoughts on that with Amazon?
No, and I agree. And to tie the web services portion of Amazon, that kind of goes into where Microsoft missed as well. With their Azure, their cloud services on Azure was a really disappointment for Microsoft last week. And so, yeah, I think there's been some shift this year from the FANG names of the world to maybe some of the older technology companies, excluding Apple. Apple's the one that has really stood out. And I think what they've continued to do is leverage their brand loyalty. They've got such a good customer experience for people who buy products from them that they've held up in the face of the weakening demand, because it is a potential risk out there right now. I mean, you look at, I'm jumping forward. We'll talk about housing later.
Let's talk about
inflation.
One other stock.
Oh yeah, let's talk about Twitter first. I'm going to come back to this idea of the old guard, or the old guard being replaced by the new guard being back replaced by the old guard again. But let's talk about Twitter first. Yeah, obviously, this is a headline news story. Just in the last 24 hours, the purchase, or I should say the it was completed. The completion of the purchase by Elon Musk happened. He is now in control of Twitter. His first action yesterday was to basically clean out the executive team, fired the CEO, the CFO, the chief legal counsel, and Twitter will be interesting over the next. Is it going to be the wild, wild west? I still think that what Elon's going to do is make it a better service. Twitter was so.
Did you see this video of him doing this?
Yeah, brought the sink in. Let that sink in.
Let that sink in.
Yeah, no, I mean, I know there are people who love Elon Musk. There are people who hate Elon Musk.
Oh boy, yeah.
I think he's brilliant. I don't believe he's going to use this as his own little personal venue to rant his political ravings and allow. I believe he's truly going to try to clean up the bots that were in there, all the false trends that were happening inside of Twitter. That's what I believe he's going to try and do. At least I want to believe it. We'll see if he can actually accomplish it or not. But I'm excited for this. I will continue to use Twitter.
Well, I'll tell you, it's pretty interesting that the market really wasn't sure that this was going to happen until it was done, and there was some opportunity there. So I was able to. I was out of the trade now, but was able to make some money off of Twitter. I'm a little disappointed in hindsight. Like I could have made more if I'd known this was going to happen. Doing something like a butterfly or some out of the money, call spread or something that could have worked. Could have been miraculous, but these opportunities come along every now and then. They're really interesting to trade. Got to be careful about how you trade them, though. So we'll talk about them more as we see other opportunities, because I'm sure there'll be some other interesting stuff coming up.
So back to this point about the shift in where cash is going right now, because for the last, who knows, decade, you could say, but definitely the last 4 or 5 years, money has flowed to FANG, right? Facebook, Alphabet, Amazon, Netflix, Google, Microsoft, Apple. There's been huge amounts of money flowing into the QQQ stocks. Tesla is another one you throw in there. As one of the, NVIDIA is another name you put into that. Huge market cap tech names. They have been getting beaten this year. Apple's holding up better than any of them by far. In fact, Apple's, with their move today, is probably not too far off of all-time highs again, though. I shouldn't say that. They probably still have a little bit to go. They had a rough go of it earlier this year. But what you are seeing is a shift from these FANG names back to the Dow Jones Industrial stocks. I mean, big earnings reports yesterday from Caterpillar, McDonald's, Honeywell, Merck. I mean, old names that you're like, those are boring old stocks that pay dividends, and they're at all-time highs. And FANG more like, dang.
Douglas is
that's funny.
Part is he's always got a good one, but yeah, I thought that was kind of funny.
That's funny.
Yeah.
So
what you're saying is that we're seeing a shift in allocation mix from these large cap tech names to and there was a report out this week that was in some research put out by Bank of America that's giving some indication that we're seeing some shifts in asset allocations. And this is the way things work. If you've ever looked at one of these quilts that show the performance of sectors, what's interesting is you look at what's on top for a particular year. If you go back, the previous year is probably near the bottom. So we get the sector rotation. So I think we're on the cusp, and this is where you're heading, right, Greg?
Yeah.
So run with it. Where do you think? Where's it going?
Well, I think we're going to continue to see this. There's been so much talk about recession and preparing your portfolios for recession and this battle with inflation is I think investors are looking at companies that, number one, are not as impacted by interest rate risk because we've got rising rates And number two, pay good dividends and have good cash positions. Now they're okay if they carry a little bit of debt, as long as it's not having to be refinanced regularly. So I think you're seeing names that have been dead money for a long, long time, just have phenomenal years this year. I think the poster child of that is Merck. The big, I believe they are originally a German drug manufacturer. Merck forever traded at $20 to $30 a share, and that's all they did. Well, they've taken off. Merck's at all-time highs right now, $100 a share right now on Merck. It's just had a fantastic year, and I think you're going to keep seeing this as money is trying to be more conservative and look for yield in places like old Dow Jones boring names. And I think you're also going to see some interest in small caps again going into 2023.
Another one I'd throw on the list, and this one hasn't taken off yet, but when you think of value stocks, you think of some of these companies like US Steel, maybe Cleveland Cliffs, haven't taken off quite yet. But these AstraZeneca is another one that falls into these big what they consider value stocks. So we're looking at companies that have PE ratios that are very low right now, and generally pay a good dividend. Now Cleveland Cliffs doesn't pay a dividend, but and the dividend's pretty low on some of these others. But the other area is, like you said, is small caps. And rather than trying to play small caps, I think the best way to do it is to take a look at the IWM, which is the ETF that represents the Russell 2000. So we look at Russell 2000 as one of the core indices, and it represents 2,000 small businesses. So this could be a really interesting play going forward for 2023 if what Bank of America put out this week is true.
I think enough people have been burnt in the last 2 years from the meteoric rise and then the subsequent crash of Cathie Wood's ARK funds, and the SPACs that were all released in 2020 and 2021, and people chasing money that are ideas that have not proven to be able to generate any cash. And so I think there's that money that's been burnt is, as they get back into the market, I think they're going to do some reallocation and say, no, I'm going to go back to some of the more conservative cash flow positive names. Now, that doesn't mean that it's necessarily that this type of investment, these innovation funds, are dead forever. I just think in the short term, that's where the cash is chasing. And it's not chasing the Snaps of the world and the Palantirs and the GoodRxs and the Airbnbs anymore. It's chasing names like Disney and McDonald's and American Airlines.
Yeah, this is really interesting because I tend to lean more on the value side. I place a lot of weight on looking at fundamentals, and it's been hard to justify even companies like Apple. I think it's hard to put a price. Then some people talking 200. I think my price conservatively was probably 140s as what I thought it was worth. And Apple's doing better than that, but it's a little higher in there. That's mostly because I don't weight as much on services, but maybe I'm wrong there. But that said, when you're looking at something like an ARK and like the valuation, the PEs are just crazy. If you look at the companies that are in that fund, it's hard to sit back and talk about valuation. And the important point is that their price is not value. The price is what you pay, and value is what you get. This is Warren Buffett and Charlie Munger's famous mantras. And there's a disconnect between what a stock is worth and what it's paying. It always exists. And these cycles that sometimes it takes longer. So the point I think we're making here is that maybe not a bad time to start thinking about going back and looking at valuations again, as a theme for 2023. Because we're seeing some economic data that might be giving us an indication that we're seeing a shift, and maybe some of the Fed policies are starting to work. What was the economic report that got your attention this week?
Housing starts, not housing starts.
Pending home sales.
Yes.
Pending homes.
Pending home sales, much bigger miss than expected. There was some expectation it was going to drop, but you look at that chart, that is an absolutely scary chart right there.
Yes,
that pending
it is.
home sales chart. I mean, it is dropping off a cliff. And let me just give you some personal perspective here. Now I'm going to throw out some round numbers because I don't have 100% insider information on this, but I do have a relatively good source. So state of Utah, I don't live there anymore. I used to, so I still have a lot of contacts in Utah. Last year in 2021, the home builder of the year, you can go Google this if you want, it's out there. The home builder of the year in the state of Utah was a company called Ivory Homes. They build kind of a middle tier house, middle to upper tier. I mean, it used to be a $300,000 to $400,000 house. Now it's the last year, I'm sure it was probably more like a $700,000 to $800,000 house is what they've been building. That's kind of their target. They're not a big $1 million home mansion type of builder, but they're also not building. There you go. Utah's #1 home builder, says right there under their name. You can believe them because they said it. They actually were the #1 home builder. They were awarded by some, oh, there it is right there. Now they were awarded by Pro Builder. Last year, they closed something like 1,350 or 1,380 homes in the state of Utah. So an average of say 130 to 140 homes per month in 2021. There you go, 685. Like I said, it's more of a $600,000 to $700,000 house now. There's an $800,000 house. I remember when I was considering, they actually didn't build my home for me when I built one down in Utah back in the early 2000s, but I had talked to him about it, and it was more of the $300,000 to $400,000 range at the time. Anyway, last year, like I say, average 130, 140 homes a month that they would build and close on. Last month, now again, this isn't an official publication, but relatively good inside source, they sold one house in the month of September.
Is that bad?
That's a pretty high percentage drop, month over month decline. And you obviously, it's shown here in the data. And this is not just unique to Utah, right? There are areas across the country that you're just seeing home sales absolutely collapse right now. And the problem is that the speed at which they're collapsing, it's even faster than you see back in 2007 and 2008. Can these companies, and you look at some of the big publicly traded ones, the big publicly traded home builders, can companies like KB Homes, can they stay alive? Toll Brothers, can these companies have deep enough pockets to stay alive? And even if they do stay alive, how many jobs that we know are associated with the construction and the home building industry are going to be impacted in 2023? Because not only do we still have elevated home prices that new home buyers can afford, but we still have, now we have interest rates that have caused the 30-year fixed mortgage to more than double where it was at the beginning of this year. So that's, to me, the biggest concern I have looking into 2023, and might be the one thing that does end up pushing us into recession. Even though we're seeing still some pretty solid earnings, I know not everywhere. And let's be honest, even Google and Microsoft's earnings were still pretty good. What dropped their stocks was their forecast into 2023. And to me, the biggest concern I have looking into 2023, even if we do reach peak inflation and the Fed stops raising rates at the end of this year, and we do get that best case scenario, the housing market's a shambles right now. And unless we all of a sudden see mortgage rates come crashing back down, people or home values come crashing back down, people still can't afford to buy a house right now.
Yeah, I don't know if you saw Peter Bookvar's tweet Peter does some really good work. I highly recommend him as a follow, and I pay for his daily newsletter, which is fantastic. But this spills over into commercial real estate too. This morning he had I guess it was yesterday afternoon, let's do some math on commercial real estate. And he just walks through, companies that have made commercial investments. And the bottom line is that they're going to come up with an extra $400,000 to cover just the interest payments, just looking at some basic math, interest rates and changes in mortgage rates, pretty significant. So this is not only affecting the consumer residential homes, but there's also a big impacts for commercial, which is exactly what the Federal Reserve is trying to do.
Yeah,
the Federal Reserve is trying to cool down these markets. It's funny listening to people howl and scream, the Fed is killing housing prices, and that's like that's how the Fed knows they're winning. That's what they want to accomplish.
Well, because let's be honest, a year ago was just as outlandish. It's just people weren't complaining about it as much, because I list a home for sale and then have 75 offers within a week. Half of them probably haven't even seen the property, and you end up selling a house for 25% higher than what you listed it for. That was what was going on last year. That's not normal either. And that's one of the things that's driven this inflation mania that's been going on, is they've got to slow down housing prices. To be honest, they've got to slow down the S&P. I think the only thing they really care about right now and making sure it functions is the bond market. As long as the bond market stays solvent, and whether it's through their actions or through the actions of Treasury, I don't think they care. I think they're going to be okay hurting equity prices and hurting home prices.
I didn't know if you were going to go on the thought about what you think is going to happen with Treasury, or some of the hypothesis there with regards to liquidity.
There is the concern right now with bond prices. Everybody's saying, oh, well, interest rates are about ready to stop. And we're going to, I know there was some, a stat I was reading earlier today. In fact, maybe you were even showing it to me about, 2 years in a row in bond prices. Was this you, or was this me reading Twitter somewhere? Must have been me reading Twitter. But a look on your face. So, people have talked about 2 years in a row. I remember what it was. So it was talking about two negative years in a row in the bond market. It's only happened one time. It's like 1956 and 57. The other 3 years has never happened. And so the idea that's thrown out there is like next year's actually going to be a good year in the bond market. And so expect the bond prices to go up and interest rates to decline next year based on historical average. Well, the problem with that thinking and my thinking with it is that you still have to have a buyer. And the Fed has been the buyer, and they're not anymore. Now, who's going to be the buyer? There's the theory you were talking about. Maybe it's Treasury. Maybe Janet Yellen steps in and says, maybe we'll do some debt buybacks and we'll do the quantitative easing and take the pressure off the Fed a little bit. And, that, to be honest, that's the definition of monetizing your debt. And that's what Japan has been doing for 20 years, right? Japan is still doing that. And they've got a zombie economy because of that. We'll see if that's where we go. But I don't see the marginal buyer for bonds yet stepping in.
Yeah, I know that's an interesting theory and something we should keep an eye on. Definitely will be getting headlines, and it'd be cool to say that we talked about it here first. I did want to share just, the other important data today. That's the PCE index. This is personal income and outlays. This is the Fed's preferred measure for inflation. And we're not seeing inflation retreating. As a response to this, we have the Fed countdown tool. In terms of November, we're 83% chance of a 75 basis point hike. So we're at 300 to 325 this is the probability. So the Fed specifies a range that's within 25. So the probability of us going up, it actually went down a little bit today. There is now a 16% chance of only a 50-point basis hike. I fully expect that it's going to be 75. The interesting thing is if we look out to December, you and I, we're looking at both ends of this spectrum. It's interesting that the probability, this has changed a little bit since we looked at it because these are live numbers, they're updated, that the probability of a lower hike, so this would be
only a 25 basis point.
Yeah, 75. Yeah, 75 and a 25 is actually, likely. But then it also went up on the upside. So this is 275. No, that's that would be 275.
275s.
Yeah. So actually right now it looks like yesterday what was priced in was a 75 in November and a 50 in December. And of course it's all going to change, and we'll have to listen to Nick Timmeros to see what it's really going to be.
So we get that next week. Are we getting ahead of ourselves? The market, obviously the market's on a tear today. It's on the back of one of the big tech companies finally announcing good earnings. There's a lot of chasing right now with this idea that the Fed is going to pivot, and that the Fed tightening is at the end of it's in sight. And so the market's ripping to the upside, and has been. I mean, the Dow, I don't know if I said this or not. The Dow is up 14.5% in the month of October. You have to go back to the months leading out of the Great Depression to have a month as strong as we are having right now.
Well, the biggest bullish days we always have are in the middle of a bear market. I mean, historically, that's where they've been. Today's looking like a pretty good day. Here's that last Thursday, this big candle that you see that was, I guess 2 weeks ago, that Thursday, very memorable day. Huge swing, and that was after the PCI report. Another big day today, I think, driven in large part by Apple. And I think some of it, of course, looking at this interpretation, trying to speculate what the Fed is going to do. And I think where you're heading is what we talked about before the show is I think people should be really careful what they wish for. Everybody's hoping for a Fed pivot. And historically, that hasn't been good for the market. It's and this is very common. We see buy the rumor, sell the news sort of thing. So the rumor of a rate cut is probably much more impactful than the actual rate cut. And this is a little bit wonky. I'm going to show this. This is from Rob Anderson from Ned Davis Research. I really, really like the stuff that Ned Davis puts out. It's very unique. They got great charts. I love their stuff. I highly recommend following Ned Davis Research and then some of the employees there. Alejandra Gindrell's my favorite, though. She's a rock star. Anyways, looking at this graph here, what we have are 4 different lines. And so this is when this dotted line is when the Fed does something. So this black line is when the Fed starts cutting. If we go back historically, when the Fed did start cutting rates, markets actually do well. And this is not, it's sort of counterintuitive. But we can actually see that when the tightening cycle ends or we get a pause, not actual reversal. We're not talking about ending the Fed policy. We're talking about going from 75 to 50. The market tends to do stagnant. So until the Fed actually does quit and reverse and end the policy and start cutting rates, we're probably not going to see. I mean, based historically, there's evidence to say that just the Fed backing off or pausing is not likely to have the big impact that people hope. I should actually back that up. So this gray line is when QE starts. So when we actually start easing, that's when the market goes up. So I know this is a little bit wonky. But the key takeaway point here is that just the Fed going from 75 to 50 or even 0 may not actually be good for the market.
Yeah, no, I think you're right.
Well, this is not me. This is not Davis. But I mean, I just point this out because I hear people see it's almost shrill. Everybody saying, Fed, please stop, please stop, please stop. And it's asset prices, my stock market, my 401k, my house value, the value of my car that I'm trying to sell, all of it's going down. That what the Fed is trying to balance is inflation and, across the groceries and gas and all that other stuff. And we've said the Fed is going to do what it needs to do to get inflation under control. So the pain will continue until we see, something break or we start seeing the CPI and PCE numbers printing significant drops. Although you had an interesting theory about how far they might go to.
Well, trying to remember my theory now.
You said that is the Fed going to stop at 2? Are they going to try to get inflation back to 2?
No, that was a tweet from Harold Malmgren. But the interesting part will be if we see the Fed come out and make a statement, something to the effect of, our past policy of 2% target of inflation maybe needs to be raised to the 3 to 4% inflation target. If that is the case, if we see that happen, that could be bullish for stocks, I think, because that could indicate that the Fed may decide to pivot. But that's bad news for the middle and lower class. 4% inflation's hard to deal with that going up every day. Because the problem is this inflation that's already occurred, it's not going away. Even if they get inflation down to 2%, the price of a gallon of milk is still, $3.50 to $3.60 a gallon now. It was $2.50 a year ago. And, that price is a real cost for people trying to feed their families. And that's not going to change. So unless wages have gone up to help offset that cost, we've got some real economic pain coming primarily for the middle and lower class. So you're right. This is why the Fed is aggressively trying to bring this inflation down, because once it's there, it doesn't come back. So yeah, markets are still ripping right now. We're up 803 on the Dow.
So I expect that we're probably we didn't talk about the election at all, but thank God that's behind us in a couple of weeks here. We're 10 days away or something like that. And I can get the spam hopefully stops on my phone and all the other stuff and the flyers that I get in the mail and the people knocking on my door. But that gets behind us. The data, is looking like a Republican sweep of the Senate and the House, which is deadlock government. So probably good for the market. I think that's being priced in, here. So we generally will see in the midterm year run up towards the end of the year. Things could change, but right now I think there's opportunity here to play this bullishly for the next couple months or so. We'll have some volatility here and there, but I think things are shaping up for a good strong end of the year.
Hey, before we wrap up, anything good you're reading right now?
Anything good that I'm reading?
Yeah.
I just got a recommendation on it's not investing related, but I just got a recommendation, and I got the Mind Body Prescription by John Sarno. There's a guy that I follow, Liberty RPF or RFP. He's really, I would love to hang out with a guy because we'd really get along. We're into a lot of the same things, but Mind Body Prescription. So
cool.
That's
I found an article I just started reading before. I'll have to forward it to you. It's called At the Tipping Point. It's just a paper. It's not a super long read, maybe 30 minutes. But it's written by a guy named Tom Morgan, who's a wealth manager, but it's not about markets. It's about society. And some of the changes we're seeing happen, and that it's part of a natural evolution of a society. And the problem is we have to absorb what we're used to in the past, and we've got to evolve right now as a society to get through this challenge that we're in right now. It's an interesting point of view. I don't agree with everything he has to say, but I think that's something we also have to get away from as a society, is having to just echo chambers to have ideas and growth. We have to read stuff we don't agree with. We have to have discussion with people we don't agree with. So anyway, I'll forward it to you. It's called At the Tipping Point by Tom Morgan.
I think the concept of tipping points are interesting because so much in life is like that. Things tend to go, and we see this in stock markets, you see it in economic data, you see it everywhere, where things tend to go, and it's like just the straw that broke the camel's back. It can continue to pile on, and then boom, it collapses. And that's, these tipping points is something that we see, which is one of the reasons why it makes forecasting and doing long-term projections difficult, because there's a confluence of things happening. Even if we know the models, there's lag effects, which I empathize with the Fed. In fact, I don't know, I didn't mention this to you, but I got my invitation yesterday to I think it's the 39th annual economic outlook summit by the Chicago Federal Reserve. It's in December. And I've participated in this in the past and actually have been recognized for excellence in forecasting. So I've actually got a couple of certificates that I probably should hang on my wall from the Fed for having accurate forecasts.
What's interesting, he starts this piece talking about forecasting. In fact, he says, the goal of forecasting is not to predict the future, but to tell you what you need to know now to take meaningful action in the present. That's the goal of forecasting.
Yeah. So, I mean, forecasting, what people are looking for is, tell me, where's the market going to be in a year? And everybody wants that. But I think what you can do, I think the best you can do is identify where are the turning points? When are the critical points? When should we expect a tip to happen? And the tip can be up or it could be down. And those things, those inflection points, I think are something you can look at. And I honestly feel like we're potentially getting behind those. I know you're probably not in the same camp. I think you're probably recession. I'm still have had confidence that the Fed is going to thread the needle and have a soft landing. We had a good GDP number this week. I don't know what your thoughts. I don't want to put words in your mouth.
No, I hope you're right. I don't. I think they're not going to thread the needle. I think we're going to, and I think it's housing that's going to break them. I already kind of said that. I just think what's going on in the housing markets, they've got to thread something way too big through a needle that they're just not going to get it done. But I hope you're right.
Yeah, they don't have an easy job. And then looking on the future, you and I will be hanging out with some Fed members in February at an event. Yeah. We'll get some insight and have a chat with them and see what they say.
Okay.
In the meantime, we've got, for those of you that are interested, this Las Vegas event coming up in December. Go to OptionsANIMal.com to get more details on that.
Come join us. It'll be great. Thanks, Eric.
Thanks. We'll see you later, Greg. Have a good weekend.
See you.
See you.